So, what even is the stock market? The stock market can get very confusing with a bunch of numbers and companies and charts, and I'm here to break that down for you. When I started getting into the stock market, I had the same question, and I'm hoping to make it easier for you, like I wish it was for me. The stock market is a place where people like you and I can buy and sell shares of companies. It sounds like a big deal because it is. Once you purchase a share in a company, you are a part owner of the company you just invested in. But first, before we get any further, we need to discuss why companies go up and down like we see on a regular basis. Prices of stocks fluctuate up and down based on supply and demand, company performance, and economic factors. An example of this is during the pandemic of COVID 19. A lot of companies' stocks crashed during COVID 19 because the world economy was at a standstill. So companies were still not able to grow and do work. They were not able to put shipment and products into stores, and customers weren't even able to go in stores to purchase these uh, products. And that caused the stock of the company to drop tremendously. Worst thing we have seen in a very long time. What initially caught my eye about the stock market was how people were making money and made it almost seamless. A way a person like you and I can make money on a stock is buying a share of a company low and selling that same share higher than what you bought it for. As simple as it sounds, there's a ton that goes into it, and we will dive into that later. A lot of people, like my parents, invest for the long term, which is a safer option. Long term trading is a little risk, which means little reward, but when invested over time, it accumulates and adds up. Other people, on the other hand, may do day trading, which is considered riskier and than the long term, but there is a higher chance of making more profit, but also a higher chance of losing a lot more money. It is also a lot quicker in the long term trading, but like we said, high risk means high reward. Now that we have basic knowledge of the stock market, we can dive into one of the biggest stocks called the S&P 500. The S&P 500 index that tracks the 500 biggest companies in the stock market in all industries including tech, healthcare, finance, and consumer goods. If the S&P 500 is going up, it usually means all of the bigger companies like Amazon, Apple, and Microsoft are all generally doing well. The reason why bigger companies have more effect on the S&P 500 than smaller companies is because it's weighted by market cap. The S&P 500 is important to the economy because it usually shows how the US economy is doing in general. If a person wants to invest in a diverse group of companies, this would be right up their alley. Generally, in the long term, the S&P 500 has proved itself to have a good and strong return, which is perfect for long-term investors like my parents. Now let's talk about some past economies and events that affected the S&P 500. During the Great Depression in 1929 through 1939, it was called the S&P 9, which was the S&P 500's predecessor. It crashed like we have never seen before, and it took 10 years to even see a turnaround happen. Another one was COVID-19 pandemic like we talked about earlier. The S&P 500 fell a whole 34% because of the panics and lockdowns that the pandemic caused. On the bright side, tech stocks hit a new all-time high at the end of the 2020 due to help from the government stimulus packages, which is economic measures taken by the government to boost the economy during crises. We don't see that happening a lot, but during pandemics like the COVID-19, they will take that initiative to turn it around. Now let's start comparing S&P 500 to another major stock called Dow Jones. Dow Jones only uses 30 well-known companies across different industries, while the S&P 500 has 500 different companies, which allows for a ton of market coverage. Dow Jones is a price weighted, which means that companies with a higher stock price have a lot more influence on the stock value. On the other hand, the S&P 500 is weighted by market capitalization, so bigger companies have a lot more impact. A big company may not always have a large stock price or market value. An example of that is Ford. Ford's market value is not as high as its size of the company because vehicle companies have lower profit margins because the products they make are very expensive compared to tech companies like Nvidia that make graphics cards or chips that has a very high profit margin. Now that you have the basic knowledge of the stock market, you're able to go into the stock market and look up more in depth videos and hopefully have a better understanding on what you're doing. Thank you so much for watching.